Morning, Scott. I'll start it off with you. What are you expecting? I mean, this is still early going. We're down a lot in the futures, but what do you think by the open?
Melissa, I think the fact that we were down just 3% last week, that we're only about 3 or 4% from the high, even when we get this ugly open, I think that's going to reassure some people. The fact that the Chinese leadership was, the quote I read, was stunned by this move certainly is not going to help. I think it's interesting that not only is the yuan below 7, it's the lowest level, the first time it's ever been there since it's been allowed to trade offshore. I understand, I believe I understand what the president is trying to do, but these are not a bunch of concrete suppliers from Queens who are going to be pressed into a corner. They have weapons as well. And I think that we're now to the point where they may just decide to wait out the president and see who gets elected in 2020. The only moving average that matters in the S&P matters because it's also a big round number, but it's a long way to the downside. That'd be the 200-day moving average at 2,800.
28, yeah, that is a long ways down. Deborah, we were just talking about the muscle memory and the reaction that, you wake up this morning, you hear all these headlines, and you think about what happened in the summer of 2015. How should investors be preparing themselves for not just today's trading day, but the length of time, ahead of us before we have any other developments on the Chinese front?
Well, it certainly seems as though treasuries continue to be a flight to quality type of instrument. The bond market obviously reacted to the Fed and the employment report last week, but overriding all of that continues to be sort of what's happening from a global economic perspective, and treasuries certainly can take the sting out of what's happening from an equity market perspective in that regard.
Are you worried about, bonds looking expensive at this point?
Well, we have a Fed that is trying to find neutral, so I don't think that interest rates are going back up very quickly at this point. Hopefully, they're staying sort of where they are without too much movement. In that sort of an environment, I think bonds don't really look expensive at this point. They look pretty much average, and spreads, continue to widen on riskier types of assets, which is, I think, what's expected at this point in the business cycle. And with treasuries, again, being sort of the safe haven, I believe they'll continue to perform very well.
Scott, it seems like there are two maybe conflicting impulses this morning from investors who've been through this cycle for a while. One is obviously these new trade threats, the currency disruption basically says, OK, we have a fragile global economy that might be tipped over into something worse. Or, on the other hand, you say it has never felt smart to sell on one of these trade headlines or one of these kind of currency moves because they've typically been relatively short-term corrective actions. What do you think is going to win out?
I think that this is different. I think now that the Chinese have said we have tools as well, to the degree that Eunice used the word weaponized, to the degree that they're going to weaponize their currency. That may not be the nuclear option. Nuclear option would be selling a bunch of treasuries that they hold. But this is a very different sort of thing. Again, they were surprised. They don't like to be surprised. I think that if you have to pick around a sector here in the United States, you might want to do that for the reason you point out. It's never made sense to sell. But, some of these sectors are also going to get hurt pretty good. One story that probably is underreported is the fact they've also said that they're not going to buy a bunch of agricultural commodities. So if you look at soybeans, they're down 6 cents, which is about 0.5%. Corn down about the same, but it's bigger, about 1.5%. So names like Deere, Caterpillar, Cummins are probably going to have a really tough time today.
We should note that Beijing has denied those reports since it was initially reported by Bloomberg. Deborah, it sounds like both of you are pretty defensive on this. So if you think treasuries are in a bad place to be, I mean, how low do you think 10-year yields go then?
Well, we think that they've hit a low at this point and probably won't go too much lower from a cyclical perspective. Having said that, they're still better than inflationary rates, and so we think they're a good place and a safe haven to hide at this point.
Debbie, last week, the high-yield bond market did not act all that well. It has been relatively firm, even as Treasury yields have gone lower. Do you think that we're in for a little more indigestion in the credit markets here?
Well, certainly, I think in this time period, you're going to see some credit spread widening. That's normal for this part of the cycle. It's a very long business cycle, and typically spreads get wider as you get a little bit further down that path. So we don't think that it will be, the overriding issue in the marketplace. Certainly, global issues tend to cloud that, but we do think that there will continue to be credit spread widening and some hiccups along that path.
Scott, I want to go back to you on this trade issue because I know you think that this is like a fault line. Something's just happened here, and it's fundamentally changing the game. But what I don't understand about this is why you actually, I mean, we're all waiting to see what President Trump says on Twitter, but why President Trump won't look at this. And I know he may feel like he's got his back in the corner and that they're trying to box him in, and that's not a good thing either. But he doesn't like the stock market to fall. He really doesn't. And oftentimes, will try to do whatever he can to fix that. And if he starts getting criticized for it meaningfully, that's going to be a different story for him and us.
Well, absolutely. And to the degree that he then starts to walk this back, that would probably be good for everybody. We know that he's tried to pillory every member of the Federal Reserve Open Market Committee in an effort to get interest rates lower. But I think that the FOMC had to have a real head slapper on Friday morning when they said, oh, my God, we've given the president cover to impose more tariffs. I mean, to a certain degree, they probably had to think, oh, we gave scissors to a child and yelled run. And the president is not the only one that's impacted by this. I think he has to realize that if he wants to make a deal, and he supposedly is all about the art of the deal, if he wants to make a deal, then he has to realize that he has to take a breath and that things are very different now that they're going to weaponize their currency.
I don't know how likely that would be after just raising the prospect of increasing tariffs. But
I don't think he's going to run to make a deal right this second. I'm just suggesting if this continues after a week
he might,
or two,
and the sell-off is pronounced,
he might find a way.
At the same time, what we have seen, Deborah, and I want to ask you about this, is, the odds of rate cuts go up, don't they, in the back half of the year off of all this?
Well, certainly the Fed doesn't want to be the ones to be blamed for any type of global problems. Having said that, they did what they thought was the best thing, which was, take what was the December rate hike out of the marketplace. They took it back. It was an insurance cut in their mind. The U.S. economy continues to perform on an okay basis, certainly not where it did in 17 and 18, but it's not going too far south. Having said that, this action on Friday and the counteraction over the weekend certainly will cause some pause for various members. There were 2 dissenters. I doubt that there will be going forward. We have 2 new candidates that President Trump has put through from a nominee perspective. If they're confirmed, those are additional votes, more than likely in his camp. So the FOMC could be at a point where they are reevaluating how they have to respond to the global economy in a way that's a little bit different maybe than what they did last week.